record high unemployment numbers, vast percentages of homeowners unable to successfully pay on their mortgages, tenants who can no longer afford their rent payments, the economy driven to shambles by shutdowns, surviving on stimulus payments and money printed by the Fed has seen a drastic increase in supply of US dollars, inevitably resulting in increased rates. Today we are talking about the future of mortgage real estate investment trusts, performing a stock analysis specifically on Orchid Island Capital thanks to the suggestion from Baron. We'll be carrying out fundamental analysis, technical analysis, and discussing business operations. Remember to watch through to the end of the video where we will talk about how the rise in interest rates will affect mortgage REITs and their share price. But first, how do mortgage REITs make their money? Real estate investment trusts, commonly referred to as REITs, are companies which invest in income-generating properties. They invest into these properties in one of two ways, by either purchasing properties and then renting or leasing them out to tenants. The second way companies do this is by profiting off the spread on the short-term money they borrow and the long-term mortgage and interest payments they receive. These are called mortgage REITs and is how Orchid Island Capital runs their business. Stock ticker ORC is a mortgage real estate investment trust currently trading at a share price of $5.38. Orchid Island Capital has a market cap just below $578 million with a 52-week range ranging from a low of 4.23 to a high of 6.22. Additionally, ORC has a beta metric of 1.31, which means their share price is going to trade at slightly higher volatility than the broader markets. Most recently, Orchid Island Capital posted an earnings per share of 88 cents with a PE ratio of 6.09, meaning that ORC's price is trading at 6 times the earnings per share. Although this past earnings report was absolutely atrocious for Orchid Island Capital, they were able to beat expectations for the second half of 2020. We most likely see this consistent and somewhat linear drop in earnings as the issue of unemployment and financial struggles for many Americans continues. This is partially fueled by the reduced stimulus payments. However, as restrictions continue to lift across the country, we should see mortgage payments begin to increase. ORC hosts a beautiful dividend of 14.5%, resulting in an annual payout of 78 cents per share, which is paid monthly. Some may consider this far too high, questioning whether ORC is a dividend trap. However, the company hosts a payout ratio of 73.58%, which is very low for a REIT. Unfortunately, the 5-year dividend growth rate is minus 15%, but this is most likely partially due to the decrease in share price. Not only does Orchid Island Capital reward their shareholders by paying them a beautiful dividend each year, but they also put into effect a share repurchase program in July of 2015 for up to 2 million shares, and subsequently in February of 2018 this limit was more than tripled, allowing ORC to repurchase an additional 4,522,822 shares of common stock. You may be asking yourself, what is a share repurchase program, and more importantly, what's in it for me? Stock repurchases, also referred to as stock buybacks, occur when a company uses cash on hand to purchase some of their outstanding shares to disband them. This decreases the supply of available shares, often resulting in an increase in share price. Additionally, buybacks may give us insight on management's belief about their value of the company, as they would generally like to perform such practices when the company is currently undervalued. From 2015 to March of 2021, Orchid Island Capital has taken full advantage of the stock buyback program, repurchasing a total of 5,685,000 common stock shares at an average price of $7.10 per share, accounting for about 87% of the maximum amount allotted. ORC currently hosts a price-to-book ratio of 1.24 and a current ratio of 0.14. Although the PB ratio is not terrible, the current ratio is incredibly low and signifies the company owes significantly more in short-term debts payable up to a year from now than their short-term assets are worth. A prime example of this is ORC's balance sheet, which shows total cash of $307 million, powered over by a monstrous debt level of $4.22 billion. Although these numbers may have you shaking in your boots a bit, they are not nearly as bad as they seem, because the business operations of Orchid Island Capital revolve around taking out large amounts of short-term debt and then paying it back using the yield on residential mortgage-backed securities which take years to mature, it is not uncommon to see such low current ratios and high debt levels for mortgage REITs. Some positive fundamental metrics for ORC are a profit margin of 84.32%, as well as a return on equity of 16.52%, which is largely fueled by their over $4 million portfolio of agency residential mortgage-backed securities. Something interesting to see here is the portfolio growth from Q4 of 2020 to the first quarter of 2021, as Orchid Island Capital has been able to drastically increase their portfolio value. Likewise, ORC reports their portfolio to generate much larger rates of return than their peer competitors over the past 7 years, often being able to beat out their peers by rates upward of 20%. Comparing ORC to mortgage REIT competitors with similar market caps shows ORC has favorable profit margins as well as significantly higher dividend yield despite having similar share prices. Before we talk about Orchid Island Capital and how they are set to be affected by this increase in interest rates, I want to remind you guys to subscribe to the channel and give that like button a nice firm tap. As the yield and maturity rate of treasury bonds has historically been dropping since the early 80s, we can conclude that interest rates are lower now than ever before. This does not bode well for mortgage-backed securities, as their value also moves inversely to that of interest rates. If interest rates rise, and there really is nowhere to go but up right now, mortgage REITs will ultimately be affected negatively, as their net asset value, or NAV, will take a hit as a result. This seems very problematic at surface level. However, Orchid Island Capital deals almost entirely with agency mortgage-backed securities. These mortgage-backed securities, or MBS bonds, are issued by agencies which have close affiliations with the government, such as Fannie Mae and Freddie Mac, making them eligible to be repurchased by the Fed, which ultimately lowers the risk profile of ORC's portfolio. Another investing strategy Orchid Island Capital is practicing to hedge their risk against the rise in interest rates is by holding short positions on the 5-year Treasury note futures contracts. As we've discussed before, when interest rates increase, the value of Treasury notes are reduced. ORC short positions account for $1,355,000 of their portfolio, and $400,000 of this hedging is set to expire in more than 5 years, while the remaining value has a time frame of 3 to 5 years. Even though the management team for ORC seems to be making some really smart moves in the way of protecting their portfolio, they are still highly leveraged, making them a high-risk hold. The economic recovery will present a very turbulent time for all real estate investment trusts, and you should know that mREITs are more risky than their equity REIT counterparts, as they have seen positive returns in 87% of rising interest rate periods. This point is further driven home by Robert R. Johnson, a member of the Fed Policy Investment Research Group, who reported that spanning from 1972 to 2013, during periods of rising interest rates, equity REITs were found to return 9.8% annually, while mortgage REITs lost 4.1%. Because mortgage REITs acquire capital by taking out short-term loans, as interest rates rise, they will inevitably be paying more for their capital acquired. However, the spread or return that they earn from their long-term maturing residential mortgages will decrease, as these securities are often issued at fixed interest rates. Neither ORC's liabilities or their fixed-rate assets will benefit from the increasing interest rates. As a result of this, if you were looking to invest into mortgage REITs at this time, history has shown it is better to invest into commercial mortgage REITs rather than residential ones. This is because commercial mortgages are often issued at floating interest rates, meaning they will benefit from increasing interest rates, reducing their drop in revenue and spread. ORC, currently trading at $5.38, has quite the up and down 1-year chart, as your eyes gravitate towards this large dip in April of 2021, which was a result of negative earnings and poor analyst reports. The share price has just recently dipped under the 20-day moving average, signaling some bearish movement may be upon us, as the Relative Strength Index, or RSI, continues to creep down to a value of 30, showing the stock is oversold. Additionally, take note that it seems that the share price has been trading sideways for quite some time now, but there does seem to be an overall upward trend, as seen by the dark gray 200-day moving average line. There's also plenty of support established at the $5 threshold, so it will be interesting to see how the price breaks out after testing the value. It is important to remember here that the share price of publicly traded companies although it's fluctuating up and down consistently, should always return to the real or intrinsic value of the company. One of the ways this value is expressed is by the net asset value, which is most likely to drop for most mortgage REITs as interest rates rise. The last two things I want to talk about before giving you my final thoughts on Orchid Island Capital are the analyst targets, giving ORC a recommended rating of 2.5, placing them just between a hold and a buy. Additionally, just something I thought would be interesting are the insider holdings at just 0.36%, which is quite low and may give insight on company expectations. Don't forget to leave me a comment down below if there is a specific company that you would like me to look at. ORC is a monthly dividend payer that has an incredibly high dividend, especially compared to some competitors in the same industry. They have been able to sustain this dividend for the past 9 quarters, which in my opinion is a very positive sign, showing that this is not a dividend trap. With ORC being highly leveraged and having a multitude of debt obligations, I do not believe that this is the proper economic climate to be investing into mortgage REITs. Some other types of companies which generally fit this highly leveraged profile are business development companies or BDCs. I would recommend, however, at least placing Orchid Island Capital onto your watch list and thinking about taking a position if there is significant pullback in the market or their share price drops a couple dollars. You must remember here to also do your own due diligence, making sure to remember that the other fundamental metrics are strong. Also, if you already hold the stock and do not want to part way with the income it's generating you and the dividend payments, you should be averaging down as the value of mortgage-backed securities decreases, slowly reducing your cost basis. I want to give a big thank you again to Baron for recommending we analyze Orchid Island Capital. Everyone else, give him a thumbs up down below the video, and please leave me a comment of your own, as I hope we can build a sense of community here. As always, I'm Patrick Zimmerman. Thank you for your time, and have a nice day.